Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the so-called passive funds that sits within our list of 72 favourite funds, namely iShares UK Property ETF. This is an exchange-traded fund, or ETF. It's designed to track the performance of the underlying assets and then deliver that performance minus its running costs. In this case, the ETF is tracking a specialist benchmark, the FTSE EPRA Nareit UK Index. I hope I pronounced that correctly. It offers exposure to UK listed real estate companies and real estate investment trusts, or REITs. The ETF uses physical replication to provide performance, which means it owns the actual underlying stocks. All 4 FTSE 100 real estate investment trusts, or REITs, feature, and overall the ETF provides exposure to 21 property and real estate companies. The top 10 represent around 2/3 of the assets under management, and the big 5 individual holdings at the moment are British Land, Land Securities, Segro, Hammerson and Derwent London. The companies in the underlying index between them offer exposure to commercial property, including offices, retail, warehouses and self-storage sites, as well as a smattering of residential property experts. This chart shows the mix by market capitalisation. The ETF is eligible for SIPPs and ISAs. Note that it distributes dividends it pays out, it pays on a quarterly basis, and the yield is around 3.3% at the moment. The ongoing charge figure for the ETF is 0.4%. The ETF is more than 10 years old and it has just under £800 million in assets under management. For those who put store in such things, the product does not have a star ranking from Morningstar. Those are the mechanics. The next question is why an investor could consider this ETF for their portfolio today, and I think there are 3 factors to consider. The first is that exposure to property can provide some portfolio diversification. The second is that the ETF pays that dividend yield of 3.3%, which easily beats the 0.5% Bank of England base rate and the 1.26% yield available on the benchmark UK 10-year government bond, or gilt. The third is that UK property stocks really haven't done that well since the 2016 EU referendum vote, so some investors may think they now may be looking cheap and a source of value in a UK stock market that's still trading near record highs. One way of judging this is to look at the relationship between the company's share price and its net asset value, or NAV per share. Some of the biggest REITs, those with exposure to London and the city in particular, or retail, are trading at big discounts to NAV. Fans of the sector will argue that this is undeserved because net asset values have continued to go up since the referendum, despite all of the worries over what Brexit may mean for the city, the UK economy more broadly, and therefore demand for commercial property. This chart shows the 6 monthly trend in NAV per share at some of the biggest stocks in the ETF over the last 5 years. In some, the doomsday scenario has not come to pass yet because rents and property prices have kept on going up and taken NAVs with them. But this is not to say that iShares UK Property ETF is necessarily suitable for everybody's portfolio, also for 3 reasons. First, although this is a property ETF, the underlying assets are stocks, not buildings. This means you're not getting the same degree of diversification that you might get from a fund that invests in the actual bricks and mortar. If there is a wider UK stock market sell-off for any reason, then property stocks too could tumble, taking the ETF with it. This chart shows how the ETF has done since its launch in 2007, and as you can see, there have been some big swings lower as well as some big gains. Second, the dividend yield does beat cash and the coupon on 10-year gilts, but there is greater capital risk. Share prices can go down as well as up, and so can some company properties' dividends. This next chart shows the dividend history in pence per share from the 4 FTSE 100 REITs tracked by the ETF. Finally, some of you may think that it's right to leave some of these stocks at a big discount to net asset value because you believe Brexit will hurt the economy and demand for British commercial property, or because you've the opinion that the internet is going to have bricks and mortar retailers for breakfast, again hurting demand for and the valuations of retail property sites. Now that's a call that only you can make, and that's why it's important that you make sure that iShares UK Property ETF fits with your own personal investment strategy, target returns, time horizon and appetite for risk before you put any capital to work. Thank you for watching, and I look forward to seeing you next time.